Hi, guys. Welcome to the How I Raised It podcast. This year, we get an inside, unfiltered look at how real entrepreneurs and VCs raise capital for their businesses. I'm your host, Nathan Beckert, and today's episode is with Celine Halioua of Loyal, a San Francisco startup creating life-extending medicines for dogs. Celine has raised $125 million, including the most recent $45 million Series B, even though Loyal is still pre-revenue. So we go deep into how to do that, including how to build out milestones and raise against those milestones, how to decide what terms are important, how to negotiate those terms, and much more. If you're tuning into this podcast to learn how to raise capital for your business, be sure to check out Foundersuite.com if you're a startup, or Fundingstack.com if you are a VC or advisor to get an awesome collection of tools for raising capital. Both platforms include a massive investor database, a CRM to manage a raise, a virtual data room to run due diligence, plus pitch deck hosting, investor updates, email tools, and much more. Last but not least, if you enjoyed this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Celine.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com. Today I have Celine Halioua of Loyal coming to us from San Francisco. How's your day going?
Going good. Going good. How's yours?
Very good. I'm enjoying this early summer weather. It's very nice.
For context, it is drizzling and raining and super cold, which I just learned walking back to my house. So,
well, I'm up in Marin, actually. So what I love about the Bay Area is you can choose your temperatures on, right? If you want
that's true.
100-degree temperature, go up to my friend's house in Cloverdale. If you want kind of 70s, come down to Marin. If you want 50s, 60s, go to San Francisco. You kind of pick and choose, right? So
but can a founder really choose? Like if you're like an early stage seed stage founder, you're probably not Marin.
Yeah, well, you're probably not. Although, I mean, a lot of founders live here and come into the city, and there are a few venture firms that are starting to spring up here. There's
really?
one. Yeah, there's one that just launched, and I forget the name already, but they are focused on Marin founders, like because a lot of second-time founders, maybe they were first-time founders in San Francisco, had an exit, moved to Marin, and now they're doing something else. So there's actually a little bit of a growing community. Nothing like Silicon Valley or San Francisco, but starting to happen. All right, well, let's go right into it. What do you guys do? What is Loyal?
We're developing drugs to extend dog lifespan. The goal of the company is to develop and commercialize the first drug explicitly FDA approved for lifespan extension, and then bring it to market and make it available for veterinarians and dog owners across the US.
And let's get into a little more on that. So what does the drug do? How did you kind of come up with this idea?
Yeah. So I definitely, didn't grow up being, oh, I'm going to start a dog longevity company. Even today, every so often, it's like still makes me crack smile when I think of the fact this is what I'm working on. It was kind of an intersection of two things, actually three things. One was this idea, interest in preventative medicine for age-related diseases. So age-related diseases like cancer, osteoarthritis, sarcopenia, Alzheimer's, Parkinson's, basically these diseases that increase in likelihood and often severity with age. And they're kind of classically considered, very different diseases, unrelated diseases. But the kind of thesis of the aging field is that actually the ways our body break down over time increase the risk of and end up contributing to these diseases we get developed and diagnosed with at 70 or 80. So you might become symptomatic, for example, with Parkinson's at age 70 or 80, but there's some work suggesting that you're actually developing the precursors of a disease 30 or 40 years before. Mm-hmm. And so the idea of the aging field is, can we target the ways our bodies break down, degenerate over time to broadly reduce the risk of, reduce the severity of, perhaps reduce the incidence of certain age-related diseases that are classically at their end stage, a very different, type of way to treat. So I've been super passionate about that ever since I was 18, because it's very, very difficult to treat age-related diseases once they're established in your body. The body has a 40-year head start on you when you're trying to, for example, bring back the neurons that are lost in Parkinson's disease. The second was a love of animals. I grew up vegetarian, still am vegetarian. Had 15 cats, 4 dogs. We rescued wild animals and rehabilitated them. So that was, I actually like dogs more than I like people. My dog is roaming around right now. Maybe she'll come visit us. And the last kind of thing was this idea of, building a pharma brand that people love and kind of bringing some of the consumer aspects, which consumer has touched basically every industry, except pharma, for a multitude of reasons that I'm happy to get into if they're interesting. But it's this idea of, can we create kind of quote unquote a high NPS pharma, a pharma that people like, that they don't feel is paternalistic, like they don't feel like is this like negative connotation, but instead it's this company that's, developing very rigorous science and developing pharmaceutical medicines, but for a kind of quote unquote positive thing to keep your healthy dog healthy longer. So long story short, they kind of all came together. I was working at a venture fund as a chief of staff, became obsessed with the idea, couldn't really get it out of my head, and realized it needed to exist, and realized it probably wouldn't happen if I didn't do it. So I started it, and that was 4.5 years ago. Now I love being a founder, but again, it was like definitely not in the 5-year plan.
Connect a few dots here. You're at a venture fund, you're seeing a lot of deals and startups, and you know that world, and you've got your 15 cats. I'm assuming those are not all at once.
No. It was at once. It was at once. When I was growing up. I was not the driver of the 15 cat phenomena.
Okay.
I was an enjoyer of it.
Gotcha. Well, when I was probably about 11, I had my bedroom. I had a guinea pig, a couple snakes, a ferret, a parakeet, a tarantula, a rat, and like probably a couple others I can't even think of it. And
that's some biodiversity.
Yes.
I mostly did fuzzy animals. We had a bearded dragon, but I had a lot of hamsters, a lot of mice. In addition to the cats and the dogs. We had a bird, a grackle with a broken wing.
Oh yeah.
Yeah, lots of lots of biodiversity at our house too.
Well, I shouldn't probably even admit this. I caught a raccoon and I tried to make it a pet, and of course it did not work out. Oh my gosh.
I would love a domesticated raccoon.
Yeah.
That idea for a multitude of reasons, in addition to being extremely illegal.
Yeah.
But
and it wants to bite you.
Yeah, and it's a harbor of a lot of diseases, rabies, but so cute.
Well, we read the book Rascal, right, as kids, and they're like, "Oh, that sounds fun." Anyway, let me get back to my question. So you have this love for animals. You're working at a venture fund. You have this vision of extending the lives of dogs. That's all awesome. But then, how do you kind of like boil it down or get started on the science part? Are you a biochemist by nature, or how do you get to that vision by starting to build product? Yep.
Yeah. So I did an undergrad in neuroscience, and I started a PhD at Oxford in economics and preventative medicine. So I was working in a gene therapy lab. I was working on gene therapies for certain blindness disorders. And so, I was technically trained. I spent probably 6 years straight in the lab, but I also was aware early on that I didn't think I was going to be a Nobel Prize scientist, right? There's just like a number of different kind of character traits that didn't feel like that was where my life was going, but I loved science, and I had kind of this interesting, I guess, talent, for lack of a better word, at finding the opportunities at the intersection of fields that don't normally interact. So, I worked on the application of nanotechnology to a neurobiology lab where they were working on tracing certain neuronal subtypes. I worked on, health econ in the context of a new class of therapies of gene therapy for ocular disorders, right? Like I was always really good at finding these intersection points. And I then went to go work at a venture fund, not because I was like, oh yeah, like venture. I actually didn't love venture, and I'm not very good at it, but I liked it because it's one of the strongest mechanisms for taking science out of the laboratory into, eventually the patient. And so I was interested in that funding mechanism. I was interested in how these ideas that were working in these labs were turning into companies, were turning into drugs. And that was why I joined the fund. And I thought I just worked there. And, I worked with a woman named Laura Deming, who's, a kind of savant in the field. And I kind of just thought my job was just going to be facilitating her. But long story short, I kind of found this other opportunity at the intersection on this, dog biology and longevity biology and the market dynamics of building a dog drug, and the realization that it just made a lot of sense. And I couldn't really kill the idea. And every time I dug in, it made more and more and more sense. And I still feel that way, 5 years later. I feel like I understand the company better today than I did 5 years ago. But it only made me have more conviction in what we're doing. So yeah.
So again, the goal is to extend the dog's lifespan, and I can understand how you would start to, research and understand where do dogs' bodies start to break down in bodies and brains, right? But then how do you start to say, all right, let's work on this? Are you looking at like human drugs and then applying them to animals? I mean,
no. So
yeah.
it gets a little complicated. Basically, the initial insight behind Loyal was that the bigger a dog is, the shorter their lifespan is. So a Great Dane might live 7 or 8 years, while a Chihuahua lives 17 to 18 years. And it's actually a really strong inverse correlation between dog size and lifespan. So the bigger a dog is, the shorter their lifespan is. And that's pretty well conserved within the species of dog. And that's really abnormal. You don't, I'm pretty short. I'm not going to live twice as long as somebody who is tall. You don't see that lifespan disparity within humans. You don't really see it in any species, actually. And generally speaking, when you look at mammals, the bigger a mammal is, actually the longer their expected lifespan is. So think, a mouse versus an elephant. So that was kind of the first, and I'm a big dog person. Again, my body is walking around somewhere. I've always been a big dog person. In fact, the team always makes fun of me because I just have too much big dog energy, and I go and pet their small dogs and they like run away because I'm coming up like this. So I'm working on that. It's a bad move for a dog CEO to not be able to interact with small dogs.
Oh, that's hilarious. That's great. Big dog energy. I love it.
I'm working on it. It's a personal development goal. But that was kind of the first thing. And then so that observation. And then the thing that was really the aha moment is that when you look at the genetics of dog size, there's really no gene that drives human size, right? I can't sequence you and be like, oh, you're however tall. But you can sequence a dog and tell with about 10 pounds how big they are. And that's because there's only about 6 genes that predominantly control dog size. And 4 of them are in this well understood longevity pathway, which actually was a pathway that my mentor, Laura, worked on and worked in the lab of when she was like 14. And she was very into that biology. And you see the same phenotype, right? So if you made a mouse genetically similar to a Chihuahua, you get a small mouse that lives a very long period of time. You make a mouse genetically like the Great Dane, you get a big mouse that lives a short period of time. And it's actually conserved all the way, from C. elegans to humans. Again, correlation in humans, right? But actually Ashkenazi Jew centenarians, Ashkenazi Jews is relevant here because they've had a number of, bottleneck events. Unfortunately, speaking as a Jewish woman, they have a genetic mutation that is similar to what Chihuahuas have in terms of lower levels of this growth hormone signaling. They're correlated with being centenarians, and they actually are statistically a little bit shorter than the kind of the Jewish family members who don't have this mutation. So basically, it was this realization that like, oh shit, maybe big dogs don't inherently need to have, shorter lifespans. Maybe this is a genetic unintended consequence of historical inbreeding for size that gave these big dogs a genetically associated accelerated aging disorder. So that was kind of the hook, where it's the connection to this longevity biology with this phenotype in dogs. And then the last kind of piece was that, this is not only interesting scientifically, but also like a market. And that actually didn't come from me. That came from our first investor, kind of heard about what I was working on and was like, before I started it, and was like, this is actually a massive market and you should do this. And he kind of brought me along, this guy named Greg Rosen at Box Group. So yeah, that's kind of how we got there.
Cool. Really cool.
All right, that was a lot.
I know we could spend an hour just on the science and all this stuff, but let's get into the fundraising a little bit. Actually, just one more question before we get to the fundraising. So you're developing drugs for dogs. You have to go through the same FDA process as drugs for humans, or how's that process differ?
It's very similar. The kind of other why now of Loyal was the new regulatory pathway opening up in the veterinary FDA called expanded conditional approval, where it basically requires the full safety standards, the full manufacturing standards, both of which are very similar to human standards, but only reasonable expectation of efficacy. This is really important because under the normal FDA rules, you'd have to run a pivotal, double-blinded, placebo-controlled lifespan extension study, which even in dogs takes a very long time. Ours is going to take somewhere between 4 to 6 years. And so if you didn't have that pathway, you'd have to run that before you could be on market. Now we run that in parallel with it being on market. We actually just started that study at the end of last year. And so that was kind of the last catalyst that made it logistically feasible, candidly, and financially feasible to develop this, because we had to path the revenue that was relatively short. It's like 4 years if we did it again, knowing everything I know now, it would be like 3.5 to 4 years. And that fits very well to kind of the venture funding landscape.
And I think I saw on the website targeting early 2025 for product launch. That
Fingers crossed.
Yeah. Wow. It's huge. I mean, it's a huge market. We've had dogs, always had dogs, and that longevity of breed, like I'm like, oh, I love this type of breed, but they live 10 years, it's a big factor, right? It's a real
it is.
thing. Like if you can get the big dog that's going to live 18 years, that's a game changer for sure. Really cool. So let's talk about raising some money for this. So how did you get this off the ground? Did you raise an angel round? Did you bootstrap it? I guess you can't really bootstrap.
You can't bootstrap bio.
Yeah. Right.
No, I raised a $5 million seed round just around the idea. So that was actually super important. You can't really hire the type of team members you need. I'm technical, of course, scientifically technical, but I'm not, science is very much kind of an apprenticeship industry, right? You need the experience that you can only get from working for decades in and as a scientist. So that type of talent is not very Silicon Valley-esque in terms of, Silicon Valley kind of runs off of like the 21-year-olds coming out of Stanford, right? Who are like good engineers. That shit doesn't fly in biotech, right? You're hiring like adults with children and mortgages and responsibilities and, houses in Marin, or actually often in our case, the Midwest. And so having a big seed round from day one was actually very important. So I could hire the kind of talent we needed. A lot of the initial ideas I had, like the thesis, this like big dog, short lifespan, IGF-1, that's been the same since day one. But the how that I had come up with and that I pitched was actually totally wrong. But it didn't matter because I hired people better than me and they're like, that's wrong, let's do this instead, right? That's how it goes. So yeah, I raised a $5 million seed off of the idea. And then we can go more into the fundraising, but as of today, raised about 125 million. All from venture capital, high net worth individuals, family offices.
It's huge. Let's get into the details there, and let's, I guess, take it chronologically. So that seed round, it was just an idea, and did you have any other scientists involved at that point, or was it pretty much just, hey?
I was still a solo founder. It was just me. Which, like, look, this was actually, I still think you could do this today. I was going to say this was the beginning of ZERP because this was the end of 2019, beginning of 2020 that I did this. But actually, like, I think you could still do it today. Because if it's a really good idea, which Loyal was, and I think it's important that you're one of the best people to start the company. I wouldn't be the best person to start a small molecule drug discovery for osteoarthritis company. Or actually, most biotech companies, I wouldn't be the best person to start it. But for this, I was. And so that combined with the idea, combined with the foundation, combined with whatever, luck also always comes into these things. It worked out.
Yeah. Was this all VC or angels and VC for that seed round?
VC, it was VC led. It was a priced led round.
Who led it?
First round and collaborative fund.
Gotcha. Okay. First round, collaborative.
And then, but yeah, there's obviously angels involved, but it wasn't like a pre-seed or anything like that.
And how did you identify what types of, you already worked in venture, so you probably had some connections. How did you sort of identify, I don't think a first round is a biotech investor.
No.
Right? Yeah.
Well, so that was actually very important. So I obviously had connections from working at Longevity Fund, but actually a lot of my connections weren't super relevant because they were mostly biotech funds and East Coast biotech funds. And I think one of the things that VC or founders really struggle at is they don't understand the economic model and incentives of the people they're working with. So East Coast biotech does not touch Loyal. They're not interested in Loyal. They don't do dog stuff, right? Like their model is not to build obviously they're happy if this happens, right? But they're not trying to build a freestanding biopharma that commercializes a drug that underwrites a new market category, right? They take zero market risk because it's not a market risk. If you have an Alzheimer's drug and it gets approved, generally speaking, that is something the world wants. It's technical risk. They underwrite the technical risk. They usually have professional CEOs, and it's an M&A thing. So actually, the turnaround time, despite the fact of going to market takes a long time, the turnaround time from an M&A perspective is relatively short because you get that proof of concept of the science, of the biology, hopefully in humans, and then somebody bigger buys the company out. And so they take a much bigger ownership at a much lower valuation, but that makes sense because of the ROI and the timeline to the ROI. That's a totally different economic model than a first round, right? Where they're taking 10 to 20% of the company and they're underwriting you to hopefully become a $1 billion company. And Loyal fit into that because despite the fact that we, of course, have, a technical core, we still don't have a product on the market 4 years later because we're going through the FDA process. The economics post-approval and the moat that you get from that and the market size and the commercialization actually all fit perfectly into their model. It's just basically the way I think about it is that the revenue is backdated, right? Most software companies have like that exponential curve, like the first year is like $1 million and then it's like $3 million and whatever, right? With pharma and bio, at least in our world, if and when we earn that approval, it's going to be a pretty high revenue product from day one, where we believe it will be, right? We'll know when we know, but there's very strong reasons to believe that's the case. And that's kind of how they underwrote it. So that's why I went to those investors.
Gotcha.
Also, I was 23, and no biotech investor is going to invest in a 23-year-old solo founder female. It's just not going to happen.
Did you even
literally not going to happen?
Post bio or everything you said? Did you already know that, or did you go pitch them and they're like, "No, this isn't a fit"?
No, I mean I talked to some, because I knew some through, but like I never actually did the rounds in Boston. And even now, like when I think a lot of this stuff is de-risked, we never get past our first or second call. They're always like, the science is super cool, but dogs. And that's fair. It's just not their model.
Interesting. Anything else on kind of identifying, did you run like a process for that or is it more? Yeah.
I ran a proper process. That's the other thing I think a lot of founders mess up. There was a kickoff point. It took about a month to raise the seed in terms of getting it fully subscribed. Of course, it took longer to close because it was a priced round. And I was in like 7 to 8 pitches a day. Granted, now with my Series B, I talked to 11 firms or something instead of the billion I talked to in the seed, but that's because there's more seed funds. And also it was just good practice. I was way, 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 way worse at pitching at the seed, than I am now. And so having those cycles was really, really important for me, but doing it super quickly, not like the drip drop method, pushes people, especially when you're doing something weird, because otherwise there's always more information you can get. Right? There's always more diligence you can do, especially when you're doing something they don't understand, which very few people understand dog longevity drugs. So that time pressure was important.
So having 7, 8 pitches a day, how else did you create time pressure? Because this is such an important thing that it's kind of nebulous. It's hard to so I'd love to hear people's stories. What else did you do other than having a lot of pitches per day? Anything?
Not really good at, so I mean, there's like all this stuff you can do, but it's like, unless you execute it perfectly, it's just like such a negative signal in terms of like signaling, what's the word? Scarcity, and that you're going to get a term sheet from somebody else, or that, somebody's leaning in. I don't recommend a seed stage founder try that. I don't do it, 5 years in, because I'm just like, I can't, I'm just really bad at it.
Yeah.
So you just have to instead engineer your company and your fundraise to kind of give that for you. So for example, with my most recent round, I only talked to a few people. I know they were all talking to background. They all had perfect information. I wasn't about to be like, oh, this person's leaning in. Like, they know who's leaning in or not, right? They know probably better than I do who's leaning in or not. I just, A, the company had a very compelling pitch. B, I created kind of quote unquote time pressure by basically saying like, I want to raise this B to increase our probability of commercial success. But if I can't for whatever reason, it's okay because I can get the drug to market regardless. Now, would I have liked to get the drug to market on the, relatively small amount of cash we had prior to the B? No, it would have fucking sucked. It would have been super painful and super terrible. But I theoretically could. And if I couldn't raise the B, I would have. Right. And so that created a time pressure because everybody knew that the closer and closer we got to that market approval, the more and more valuable the company was going to become. Right. So that combined with the fact that I was talking with enough people is what kind of gave that like FOMO, so to speak, because the other thing you have to think about is the fund model, right? And there's a few funds where like, a Series B valuation is within striking range, a Series C valuation or a post-approval valuation, they can't get the ownership they want anymore. And so it's like, well, it's now or never. If you believe in the company, you better invest now, right? And so I have found that those, I guess I'll call them just true and like structural kind of time pressures are much more effective. Again, if you're like a super suave dude, maybe you can get away with, doing it the other way, but I never have been able to.
But that's everything you just said is really interesting. And to kind of synthesize it, I'm taking notes. I mean, like with this Series C, the time pressure was, hey, the closer we get to market approval, which hopefully is early 2025, the more valuable this company gets, the less ownership you're going to be able to take for a given amount of money. And that's a time pressure. You got to invest now, not 6 months away from market approval, right? I mean, that's interesting.
And just designing your milestones really well. And again, it's like this becomes easier the better your company is, right? I had a really strong argument of why I think we're going to hit our future milestones. Of course, it's a diligence point. Of course, they had to make their own assessment, but most came to the conclusion that I did, which is that it was, whatever percent likely that we were going to hit these milestones. If you believe we're going to hit the milestones and you believe that those matter, you should invest because we're going to be worth more in 6 months. So yeah, it just really means that you have to understand your audience, you have to understand your company, and you have to understand your value inflection points.
Let's actually take on that, because I wanted to touch on the Series A for a minute, but maybe talk about the milestones when you're going into Series A, if you can remember this. What were the milestones you had sort of achieved, and what were you presenting to the Series A folks? That hey, here's what's next and why you should get in now.
Yeah, so Series A, I think that was actually my worst run fundraise. And if it hadn't been ZERP, I don't know if I would have gotten away with it, candidly. Way worse run than my Series B or my Series C, actually. And that was actually, it wasn't because I didn't know what I was doing. It was because the stage of where the company was at, it was growing, and I was so involved in the day-to-day that I couldn't step back from the day-to-day of the company to run the raise properly. So I was kind of 1 foot into the raise, 1 foot into the company, versus for context for the Series B, I just said, guys, I'm gone. 1 month, I'm out. If there's a fire, if the company's going to explode, call me. Mm-hmm. And I would get a weekly update from my execs. But otherwise, I just completely disentangled myself from the company, because at least, again, I'm a solo founder. I can't separate the mindset and the place I need to be mentally for fundraising with where I am when I'm operating. And I find when I'm in the middle, it's actually very ineffective. So disclaimer to all of that, the Series A milestone was 1, I don't suck, which I think, founders underestimate. You're a first-time founder, you're a solo founder, you're an unknown quantity. They have no idea if you are good or not at the seed. They hope you are. You have some pattern matches and some background, but they actually have no idea. I had, I think, hopefully a decent amount of evidence that I had the possibility of being a, really good founder. I was scaling. I was learning from my mistakes. I was, had a bias to action, all the things that CEOs look for, or VCs look for, right? And what a good CEO should be. So that was 1. 2 is I built a decent team, which also reflects on me and my ability to hire and scale and whatever. And then technically, we had proof of concept of the drug. We had de-risked the regulatory pathway, and we just had a way better understanding of the commercialization and the go-to-market for what we were doing. And so really those milestones, and again, I think a lot of it was just the validation of the idea and the validation of the team, aka the founder, because that's the biggest team member you can't get rid of, really. That was really the Series A milestone.
Do you remember, actually, I always like to talk about the size and shape of the funnel. Do you remember how many investors you pitched at the seed, and then how many at Series A?
I talked to 100 plus at the seed. At the A, I don't remember. It probably was 50. There's less funds who will do things each round. I only got 1 term sheet at the A. We got multiple at the B, and we came in with a term sheet at the seed for half the round. So we were trying to find a co-lead term sheet.
And I think you said you talked to 11 or so at Series B. I'm jumping all over
here. Firms, yeah.
Yeah. Uh-huh.
In terms of lead candidates, there's a little bit of difference because we had a lot of insider interest, demand, so to speak. So the round was basically filled. It was just needed to get a lead.
Who led the Series A?
COSA.
Okay, right. And then Series B, jumping all over, but this was Bain Capital, correct?
Bain, yeah. And then Valor was a big investor.
And so, and that was a pretty big round. And then you also took on some debt or credit facility. I don't know if that's interesting or not, but anything there? What was the thought process?
I use debt as an optionality. It depends on your company, right? For us, we're pre-revenue, pre-approval, and, approval is, not really in our control, so to speak, right? FDA could ask for more work. They could have feedback on something that we didn't anticipate, and these cycles take a long time. So, I use debt as a lever mostly with investors, actually. So it's kind of like pull the ripcord. If I'm back against the wall, I have 6 months. Right? So you negotiate it when you're in a position of strength, you don't spend it. If you do spend it, you just have to know that there's a lot of companies that have died from their venture debt being pulled. So it's a risk reward. I've seen a couple of that times happen. So I'm actually pretty scared of venture debt. I also picked a bank that we have a good relationship with. Our new debt provider is the same as our previous debt provider. We've built a really strong relationship. They really understand the company. They understand what I'm trying to do at Loyal. And that was really important. I actually took slightly worse terms from them than other options we had on the table because I thought that relationship was super valuable at this stage. Post-approval, when we're financing things like manufacturing and stock and things that will have like a relatively fast turnaround, it'll probably become more transactional. It'll be more of, I don't want to use venture dollars to finance the pre-manufacturing or pre-ordering of however many kilos of drug.
Right. Very interesting. What have we not covered? There's so much interesting stuff.
A lot.
Anything on negotiating terms? I mean, as a pre-revenue company, it's interesting because you're a little different than most startups we've had on the show in that you're right, no revenue, but if this succeeds and you pass the technical risk and all that stuff, it's probably huge revenue. So how do you sort of negotiate terms around that? I don't know if that's a good question or not.
Yeah.
Yeah.
So I don't know if my negotiation style is pretty, I wouldn't say it's sharky. I would say basically it's this. I go in and I'm like transparent. This is what I care about. Like, so going into Series B, I told everybody in a pitch, I want to retain control of the company. That is a non-negotiable. I want to retain board control. Additionally, I don't think I've talked about this publicly yet. I got super voted. That was important to me. It wasn't as important as board control, but I wanted to lay the foundation for having more control of the company. And I felt like I was in a position to negotiate that, right? Those were super important to me. Price. I wanted to so one thing we've done is taken safes in between every price round. And kind of use that to like anchor the next round's price. So I was like, I want to clear my safes. That was super important. I actually, we ended up not getting like a super high markup from the safes, but I thought that was actually quite fair. It was still a very good, healthy valuation, but I thought that was fair considering when I priced those safes, it was market crash, and this was a post-market crash growth round, right? So I was like, I just want to clear the safes. I don't want to get dinged on that discount. That was the second thing I went in with. And third, I wanted a good partner. Right. And that was basically it. And I didn't play super hardball on price. I think I could have. We were super oversubscribed and maybe a cleverer CEO would have. But I think for me, I really like the partners around the table. I wasn't particularly looking to cut them out price-wise. I think the price we landed on was fair. And I feel like very obviously, like a very obvious path to markup, right? I'm not trying to price to perfection. Given the complexity of what we're doing and the weirdness of what we're doing and the weirdness of the market. But I made it super clear that like, we can horse trade on those things, but like it was non-negotiable to horse trade on control. And then there was like other sub things around like how preferred voting works and, things like that, that I negotiated also. But I tend to just like say what's important, right?
Yeah, I like that.
And they tell me what's important to them, and I try to find something that's mutually advantageous. And I think you actually learn a lot about the partner you're potentially going to work with in that way. We had people who were really like disingenuous, right? That taught me more than if I had not been as open, right? Because even if I had gotten what I wanted from them, that was really important data that made me like question things a bit more. Versus, Bain, one of the things I really appreciate is we just like went and got dinner and we talked about what we care about, right? What they needed for their fund, what I needed for my company, what I cared about, which ones I cared about more, which I cared about less. And yeah, like I didn't price it to perfection, but I don't particularly care.
I really like that. This is what's important to me. Here it is. Can negotiate around this, horse trade a little bit, but why is control so important to you?
Because It's, well, for a couple of reasons. One is I think I've justified continued control of the company. I don't think like a biopharma CEO could do a better job than me at this stage. I think biopharma executives can do better jobs at certain aspects of what we're doing, and I've been hiring those people. But I think the kind of vision of a pharma brand that people love and a consumer brand around a dog product and direct distribution to dog owners and veterinarians, like that's very non-consensus. That's very founder-led vision. And I did not want a situation where, something goes wrong at Loyal, I misjudged my investors or whatever it is, and then they replace me. If you lose board control, nothing you can do. And Loyal is like fundamentally, in my view, my company, right? I obviously have a very important relationship with the investors now, but this vision is like my life's work. So I wasn't willing to let somebody take that away from me. And if I did stop scaling, I want to be in a position where we have a conversation about that, right? Not that I just get fired blind at some board meeting. So that was one.
Right.
And the super voting doesn't affect anything in the short term. It's for when you eventually go public. And that was super important to me because the bigger vision of Loyal is to take what we learn in dogs and build, human aging drugs too. And that's actually going to be, I think, very non-consensus if we're a public company, because we're going to have a pretty direct path if we're successful to becoming an animal pharma, right? And that's double-digit billion-dollar opportunity in terms of market cap. And it is much higher risk to go dog to human than it is just to stay in dog. And so I think I need to have control of the company if I want to make that jump. And so my investors right now are very aligned with that because they're excited about the short term. I in the deck I talked about as a single-digit billion-dollar company in dog longevity drugs, and then also in a moonshot or Mars shot of building the aging pharma that works on dog aging drugs and human aging drugs. And so they're aligned, but like short-term public market investors will not be aligned with that. So I wanted to set that precedent now. So yeah, basically it's so that I continue to have the ability to do what I think is right for the company.
Yeah. Mars shot. I haven't heard that phrase. I've heard moonshot, of course, but
moonshot feels
shot,
too
like
close. Like building the aging pharma, I don't know. There's an extremely tiny chance you can pull it off.
Yeah.
But I think it's worth it, and I think it is actually a valid path.
Awesome. And just very quickly, we don't need to go into this too deeply, but when you say you wanted to clear your safes, can you just describe for anyone listening what that means?
Oh, so we had raised about 20 million, maybe more, 26 million, I don't remember. Some large amount on safes. In between a seed and the A and the B. Because the A was at the end of 2021. The B was at the beginning of 2024. I think I have that right. Yeah, I think that's right. And of course, in the middle there was a market crash. And so I raised on safes pre-market crash, actually, thanks to Josh Koppelman from First Round, who gave me a call and said, everything's going to shit, take more money. God bless, that literally saved the company. And then I did another quick safe note. Well, it took a long time, but small, but 8 million safe note in 2023 to be able to say, to the earlier point of like time pressure, that got us to, with the cash we had in bank, to be able to get the drug to market even without taking another dime. Again, would have been super tough, but we could have done it. And so we had about 28 million in safes, and safes are, symbol group in future equity. They were on a capped note. And if I raised at a price lower than the capped note, and some of them had a discount too, the post-crash ones had a discount too, in addition to the same cap. If I raised below the price, all of them would slam down into that price. So let's say if the safe was at a 200 million and I raised at a 150, all the safes would convert at a 150. And then the discount ones would go even further. Right. And so I basically calculated the valuation we needed to have to clear the safes, aka for all the safes to convert at their cap. In this example, 200. And basically said that's my valuation floor. Again, I would not never necessarily recommend going in with a hard number on valuation for a multitude of reasons. You'll anger people, you could scare people away in this market. But that was just kind of it worked for the dynamics we had.
Yeah. Interesting. And if you hadn't been able to do that, I guess you would have suffered the dilution, right? I mean, if you come down at a lower valuation, is that correct?
And it wouldn't have been the end of the world, right? Yeah. But because I had leverage, that was just kind of like, look, I don't want to take that. And it was a good deal for the safe holders. They, got their prize, and it was a good deal for the B.
Yeah. All right. I know we're almost out of time. What if you would? This is one of my favorite questions. if you go back in time and give your younger self just a few years ago, you're not very old, but your younger self advice on raising capital, what would you tell yourself?
I don't know. I mean, I've had a lot of learnings. I would say the biggest one would be understand the company's milestones and understand how they translate into reduced risk and valuation. Not valuation as like anchoring on valuation, but valuation in terms of, let's say it's consensus that it's $1 billion company if we get approval, right? If you're at 50% probability of that occurring, what milestones are like as the market considered? Okay, there's a 50% chance now that Loyal achieves this. For the seed, there's probably like a 1% chance. And what does that look like and how do you de-risk that? I just didn't have a really good understanding of how milestones worked. I had a very like technical view on milestones. I didn't have a very like financial markets view on milestones. So yeah, I'd probably say something like that is the biggest thing. But also it all worked out, like I'm sure I'll look back on me right now in like 2 years and be like, oh God, like if only I had known to do this instead of that. So it's just kind of like your learning journey you have to go down.
Yeah. You don't feel like there's anything that you would totally do differently. I mean, it is working out pretty well. It sounds like.
Knowing what I know now, I would have raised less of the seed, but I also think it was the right decision with the information I had at the time to raise more. We ended up being right on the first shot on goal about the drug. But if I hadn't, I wouldn't have been able to raise again.
Yeah.
So yeah, I wish I hadn't sold that much of the company at seed. Also, whatever.
Yeah, right.
So yeah.
Very good. Anything else we haven't covered?
I mean, yes, but I think the last thing I'll say is like get really, really good at getting feedback from VCs without asking them for it because they won't give it to you. They just won't. They don't have the incentive. They're not going to give it to you. Instead, like pay attention to body language, pay attention to when you lose people, pay attention when they stop pushing or pulling, right? And edit your deck off of that. I think that's one thing I've been really good at is getting feedback when people don't give me feedback.
Interesting. Mostly body language or more just, hey, these guys aren't returning my emails very quickly anymore.
Body language, where their eyes light up. This is why I like in-person pitches. I think it's just really hard to do over Zoom. But you can kind of see when you lose somebody or when you get somebody.
Right. Yes. Very good. I love it. Really interesting stuff. If people want, is there anything you want to plug? I mean, they can't buy it yet. Is there any waiting list or anything people can get on?
No waiting list. I don't want to go to jail. I mean, look, if you have a dog and you're interested, you can sign up for our email list and you'll get to know about it and get more information about the science and, whether it might make sense for your dog in the future. But otherwise, nothing really. I don't know. Just keep on working on things that matter. That's what I'll plug. Don't build boring shit. Build important things.
Yeah. I like it. I mean, it's really interesting as a dog lover and animal lover. Loyal.com. And well, thank you for coming on the show. Really great to have you here. And we'll catch you after your next round. And maybe, do you think you have to raise more money before getting to market or maybe you can't answer?
No, I don't think so.
Yeah.
I think maybe we'll decide to, but we don't need to.
Yeah. Awesome.
Unless something goes disastrously wrong.
Cool. Well, thank you so much. Really cool stuff. Keep doing what you're doing and we'll catch you at some future point and get back on the show maybe.
Thank you.
All right.